Welcome back to Talk Tickers. It is Sunday, January 25th, 2026. Today, we are cracking open the books on a company that I think might be having, well, a bit of an identity crisis.
I think I know who you're talking about.
Or, maybe they're just smarter than everyone else in the room. We are looking at SLB, the giant, formerly known as Schlumberger, and their Q4 2025 earnings call.
And honestly, identity crisis might be a little harsh, but I see where you're coming from. Usually when we cover oil services, we're talking about, mud, pumps, drill bits.
Right.
But looking at this release, suddenly we're talking about AI infrastructure, data center cooling, software recurring revenue. It's a different story.
Exactly. I went through the transcript and I had to double check the ticker symbol a few times. They effectively pulled a server rack out of an oil well.
Right.
But here's the thing. The market isn't confused. The market loved it. SLB shares popped anywhere from, 3.4 to 4.7% intraday right after this dropped.
The market is buying the narrative. And the narrative has clearly shifted from we drill holes in the ground to what they're calling quality plus optionality.
Quality plus optionality. See, that sounds like corporate bingo to me. My job today is to be the skeptic. I want to know if this is just a legacy dinosaur trying to dress up as a tech unicorn to boost its stock price.
A fair question.
Or if there's actual substance here. Because looking at the stock chart, they needed a win.
They did. There was a lot of pressure coming into this print. Remember, the stock had actually run up a bit in early January, mostly on rumors about Venezuela, which we'll get to.
Right, the Venezuela hype.
Yeah, but that meant expectations were high. If they had missed on the core numbers, the sell-off would have been brutal.
So let's start with the report card then. Did they actually make money, or is this all just future promises?
Oh, they made money. The fundamentals arrived to back up the hype. Let's look at the beat. Adjusted earnings per share EPS came in at 78 cents.
Okay.
The consensus on Wall Street was 74 cents, so a 4-cent beat.
Which, in this macro environment, is decent.
It's solid. And on the top line, revenue hit $9.75 billion, beating the consensus of $9.56 billion.
Okay, so that's up about 5% year over year.
Exactly. So despite all the noise about a slowdown in drilling, they are growing the top line.
Okay, so they beat the estimates. That's good. But lots of companies beat estimates and the stock still drops. What was the signal that made investors actually push the buy button?
It was the cash.
The cash.
Specifically, the return of cash to shareholders. Management explicitly stated they plan to return over $4 billion to shareholders in 2026.
$4 billion. That's a serious number.
It is. That's a combination of dividends and buybacks. They raised the quarterly dividend by 3.5% to just under 30 cents a share. But the buyback commitment is the real safety net. They're targeting the same $2.4 billion in repurchases they did in 2025, but they left the door open to increase that.
See, that's the confidence signal I look for. You don't promise to hand out $4 billion if you think the oil market is about to crash.
Exactly.
That tells me they see a floor under the business.
Precisely. It validates the price action. It tells you we are generating so much free cash flow that we can afford to pay you just to hold the stock.
Okay, so the bank account is healthy, but I want to dig into how they're making this money because the mix is changing. And this brings us to the first part of their quality argument, which is the ChampionX integration.
Right. The big acquisition.
This was a massive acquisition. Is it actually working or is it just bloating the revenue line?
No, it's working, and it's fundamentally changing the financial profile of the company. To understand why, you have to understand the difference between well construction and production systems.
Okay, break that down for us.
Yeah.
To the average person, it's all just getting oil out of the ground.
Sure. Well, construction is drilling. That is highly cyclical. It's boom and bust. When oil prices drop or when operators get cautious, the first thing they do is stop drilling new wells.
Right.
They lay off the rig crews. That revenue stream can dry up overnight.
Right. It's like construction. If the economy tanks, you stop building new houses.
Exactly. But production systems, which is what ChampionX specializes in, is about keeping the existing wells flowing.
Oh.
This involves specialty chemicals, artificial lift systems, pumps. Even if you stop drilling new wells, you can't afford to stop maintaining the ones you already have.
So drilling is like selling new cars.
Yeah.
And production systems like selling the auto insurance and the oil changes.
That is the perfect analogy. It's an annuity. It smooths out the cycle. And we saw the proof of this in the Q4 numbers. North American revenue for SLB was up approximately 26% year over year.
Wait, hold on. I read the macro reports. Land drilling activity in North America is soft. Everyone says the Permian is flat or declining. How on earth is their revenue up 26% if drilling is down?
That is the ChampionX effect.
Okay.
They aren't relying on new holes being punched in the ground. They are selling into the massive installed base of existing wells. ChampionX contributed, what was it? $879 million in revenue and $206 million in core profit just this quarter.
So they've effectively decoupled a huge chunk of their revenue from the volatile rig count.
Exactly. That is why they call it quality. Investors are willing to pay a higher multiple for steady, recurring revenue like an annuity than they are for boom and bust drilling revenue. It makes the stock less risky.
Okay, I buy the chemical annuity argument. That makes sense. But now I need you to sell me on the part that made me roll my eyes when I first read it. The stealth tech pivot.
You mean the data centers?
I mean the data centers.
Yes.
SLB is an oil services company. Suddenly they're talking about data center solutions and AI infrastructure. To me, this screams management team trying to use buzzwords to get a tech valuation.
I get the skepticism.
Is there actually any meat on this bone?
There is surprisingly a lot of meat here, and it comes down to physics.
Physics.
Yes. Think about the problem data centers are facing right now. We're moving into the era of massive AI clusters. These new chips, the H100s, the Blackwells, whatever comes next, they run incredibly hot.
Right.
Traditional air cooling, just blowing fans on a server rack, it simply doesn't work efficiently anymore. You need liquid cooling.
Okay, and what does SLB know about liquid cooling?
Well, who has spent the last, 80 or 90 years figuring out how to manage massive industrial power loads, pump complex fluids, and manage heat exchange in some of the most hostile, high-pressure environments on Earth?
The guys cooling drill bits 3 miles underground.
Correct. SLB is leveraging their industrial supply chain and their engineering expertise to manufacture modular data centers and liquid cooling systems. They're building the physical shell and the cooling infrastructure that allows these AI clusters to run without melting down.
So they aren't trying to build the chips or the software models.
No.
They are building the fridge that the chips live in.
Exactly. And that fridge is becoming a massive bottleneck for the tech industry. SLB cited $460 million in data center hardware revenue in this report.
$500 million.
In hardware.
Just in hardware. And their goal is even more aggressive. They are aiming for a $1 billion revenue run rate for this business by the end of 2026.
$1 billion is not a hobby. That's a legitimate business line.
It is.
Yeah.
And here's the so what for the investor. This is a multiple expansion play. Oil services stocks typically trade at a PE multiple of maybe 8, 10, maybe 12 on a good day.
Sure, it's low.
It's low because people worry about the long-term future of oil. But AI infrastructure stocks, cooling companies.
They trade like tech stocks, 20, 30 times earnings.
Exactly. If SLB can convince the market that a significant chunk of their future growth is coming from AI infrastructure, and they're referencing things like their Tele AI launch to bolster this, they stop trading like a dirty oil stock and start trading like an industrial tech stock.
It's a brilliant sleight of hand. They're pivoting the narrative from we help pump fossil fuels to we enable the compute revolution.
And with over $1 billion in annual recurring revenue on the software side, growing at 15%, plus that $1 billion run rate on hardware, it's becoming harder for the skeptics to ignore.
They're hitting the rule of 40 on their digital business. I saw that.
They are.
Remind our listeners what that is.
It's a SaaS metric. If your growth rate plus your profit margin equals more than 40%, you're considered a top-tier software company. SLB is hitting that.
That is wild. A century-old oil driller hitting SaaS metrics.
I know.
But we have to be realistic. They still make the vast majority of their money from traditional energy. And the story there seems to be a change of address.
The geography has shifted completely.
North America land seems to be the cash. Cow milk it for cash. But don't expect growth. The growth is all international.
The international engine is what they call it. Middle East, Asia, Latin America. And the biggest component of that is what we're calling the Saudi U-turn. Right, because 2025 was a little weird for Saudi Arabia. They tapped the brakes on production.
They did. There was a decline in activity, and that spooked the market. But in this call, management was very explicit about a rebound. They expect rig counts in Saudi Arabia to return to early 2025 levels by the end of 2026.
That's a pretty confident call. A V-shaped recovery in the most important oil market in the world.
It is. And it's not just land rigs in the desert. The offshore numbers are staggering. OneSubsea, Their joint venture for underwater equipment is targeting bookings greater than $9 billion over the next 2 years.
$9 billion in bookings. Where is that coming from?
Deep water, Namibia, Angola, Brazil. We're seeing a massive cycle of investment in offshore production. These are huge, complex projects that take years to build.
And I assume these contracts are stickier than a fracking job in Texas.
Much stickier. If you're building a subsea production system in Brazil, that's a multi-year partnership. You don't just cancel that because oil drops $5. It speaks to the visibility of their earnings.
Right. They can see that revenue coming.
They can. Management used a phrase I liked. They said the headwinds of 2025 are becoming the tailwinds of 2026.
Right. The headwinds were oversupply and project delays. Now demand is catching up and those projects are coming online.
Exactly.
Okay, now we have to talk about the wild card. The elephant in the room. Or maybe the jaguar in the room. Venezuela.
The optionality.
This was the driver of a lot of that price action in January before earnings. But usually when we talk about Venezuela, it's a horror story of sanctions, frozen assets. Why is SLB even involved there?
SLB is in a very unique position. They're effectively the only international service company that never really left. They have maintained facilities, they kept equipment there, and crucially, they kept local personnel on the payroll.
They mentioned an alumni network, right?
They did. They explicitly stated they have about 2,000 alumni former employees in the country that they can call upon immediately.
So explain the play here. Why does the market care right now?
It's a call option on geopolitical change. There's a lot of speculation, and it is just speculation, that the U.S. posture toward Venezuela might shift. If sanctions ease, Venezuela needs to rebuild its oil infrastructure from scratch.
And SLB is the only one with the keys to the gate.
Exactly. If the market opens up, SLB has a monopoly on the initial ramp-up. Every other competitor would need 6 months or a year to mobilize. SLB is already there.
So if the geopolitical winds shift, they win big. If nothing happens.
If nothing happens, it costs them very little to maintain the status quo. They've been doing it for years. That's why it's optionality.
Yeah.
You aren't paying for the Venezuela revenue today.
But if it happens?
If it happens, it's pure upside.
It's a lottery ticket, but they already hold the winning numbers if the draw happens.
And the stock price run-up suggests the market is starting to price in a non-zero probability of that happening.
Okay, let's zoom out. Let's look at the guidance for 2026. They're projecting revenue between 36.9 and 37.7 billion. EBITDA, around 9 billion. The margins look steady, but I want to connect this to the macro view the CEO shared. He had a pretty contrarian take on OPEC.
He did. The CEO has a very specific view on global spare capacity. Right now, the market is worried about oversupply. OPEC has these 2.2 million barrels of cuts that they are supposed to unwind.
Right. Everyone thinks it's going to flood the market.
But his view is that spare capacity is actually much tighter than people think. He believes that once those cuts unwind, there isn't much left behind it. The tank is running dry.
Which implies a supply crunch is coming.
Specifically in 2027. And if the market tightens, crude prices go up, and E&P spend has to go up. When E&P spend goes up, SLB's pricing power goes through the roof.
And while they wait for that, they're being incredibly disciplined with their own checkbook.
That is a capital discipline piece.
Yeah.
They're keeping CapEx capital expenditure tight at roughly $2.5 billion for 2026. This is despite the growth in data centers and the international rebound.
They're doing more with less.
That's the idea. And it preserves the free cash flow. They generated $4.1 billion in free cash flow in 2025. By keeping spending tight, they ensure they have the cash to fund those buybacks and dividends we talked about.
It's a very shareholder-friendly structure.
It is.
So let's summarize this deep dive.
Yeah.
We have a company that is beating earnings. They've successfully pivoted into high-growth tech, hardware, and recurring revenue software. They're riding an international oil rebound in Saudi and deep water.
Mm-hmm.
They hold a unique lottery ticket in Venezuela.
Mm-hmm.
And they're paying shareholders $4 billion to wait for it all to play out.
It's a very robust thesis. It's rare to see a company that's considered a value stock, which is what oil services usually are, having so many growth levers available to pull.
All right, that brings us to the part of the show where we stop being analysts and start being a little imaginative. This is not financial advice segment.
The best part of the show.
Disclaimer time. We are just two voices on a deep dive. We are not your financial advisors. Do not trade based on what we say. Do your own research. If you lose money, don't tweet at us. Okay, are you ready for the pitch?
I am ready. What is the outrageous but plausible trade for SLB?
I call this trade The dirty tech and dictator double down.
The dirty tech and dictator double down. Okay, I'm intrigued. Walk me through the logic.
Here's the setup. You go long SLB, but you aren't buying it as an oil services company. You have to mentally reframe the asset. You're buying it as a data center cooling hedge fund.
Okay.
That effectively owns a call option on the Venezuelan government.
Okay, I'm following.
The outrageous angle is a sum of the parts valuation play. We know they're hitting $1 billion run rate on data center solutions. We know the market values AI infrastructure at insane multiples, let's say 20 times revenue.
Right. Look at companies like Vertiv or the other cooling specialists. They trade at massive premiums.
Exactly. So you pitch that SLB should and eventually will spin off its data center business as a separate AI infrastructure ticker. If the market values that $1 billion business at a 20x multiple, that's $20 billion in value unlocked. Right there.
Which is a significant chunk of SLB's entire current market cap.
Exactly. If that re-rating happens, the re-rating alone pays for the trade. You essentially get the core oil business and the Venezuelan monopoly for free. You're buying a tech startup inside a legacy industrial giant, and you get the geopolitical lottery ticket as a bonus dividend.
It is aggressive, but the logic holds up on the math. If they really do hit that billion-dollar run rate and exit 2026 with strong growth, an activist investor could easily come in and demand a spin-off.
Of course.
It stops being an oil story and starts being a conglomerate discount story.
You change the letterhead. We aren't an oil company. We are a global energy and compute infrastructure company.
Global energy and compute infrastructure. It has a nice ring to it.
The multiple expands, you sell the news, and you retire. It's the ultimate rebranding exercise.
Just remember, listener, spin-offs are complicated, and betting on Venezuela is... well, it's betting on Venezuela. It is high risk.
Very high risk.
But as a thesis for why the stock might be undervalued today compared to the sum of its parts, it's compelling.
Absolutely. So let's wrap this up. SLB beat the numbers. They promised $4 billion in cash returns. They are successfully pivoting to digital and production, making their revenue smoother and higher quality.
And the final thought for me is that the international rebound is real. The Saudi rig counts coming back is a huge signal, but the data center business is the sleeper story of 2026. Watch that hardware revenue number in Q1 and Q2.
That is the key. If they keep printing growth in data centers, this stock changes its identity. So the question for you listening right now, do you buy SLB as a tech stock now? Or is it still just the best house in a tough oil neighborhood? That's what you need to decide.
It's going to be a fascinating year to watch.
It certainly will. Thanks for joining us on Talk Techers. See you on the next deep dive.